At this point in my life, after observing nearly a full century of economic cycles, I feel compelled to speak openly about subjects that are often brushed aside as exaggerated or uncomfortable. One such subject is the long-term stability of the U.S. dollar. This is not a popular conversation, and it certainly isn't a dramatic one, but it is a necessary one. Let me be absolutely clear from the beginning. I remain deeply confident in America. I have always believed in this country's extraordinary ability to innovate, adapt, and recover. The combination of entrepreneurship, legal structure, creativity, and resilience that defines the American system has repeatedly proven its strength. Time and again, the United States has corrected its course when conditions demanded it. However, genuine confidence should never be confused with blind trust. A seasoned sailor may believe in his ship, but he does not ignore dark clouds forming on the horizon. Preparation is not pessimism, it is responsibility, and today's economic environment presents signals that deserve calm, rational attention rather than dismissal or panic. Over the past several decades, and especially during periods of crisis, we have witnessed an unprecedented expansion in the supply of money. At the same time, government debt has grown steadily, eventually surpassing the size of the entire economy itself. Layer onto this the increasing global competition to the dollar's dominance, shifting trade alliances, and technological alternatives to traditional finance. And a simple reality emerges. Currencies are subject to pressure, just like any other system built on confidence. This is not about fear-driven theories or sensational predictions. It is about arithmetic.br. When the supply of something increases rapidly, while its underlying productivity does not grow at the same pace, its value declines. This principle is not political, emotional, or speculative. It is mathematical. It applies to commodities, labor, and money alike. Currency is no exception simply because it feels familiar. The critical question then is not whether catastrophe is imminent. That kind of thinking leads nowhere useful. The more productive question is this: how does a thoughtful individual prepare responsibly for the possibility of long-term currency erosion without abandoning reason or hope? What actually preserves purchasing power if a currency weakens over time? Which assets adapt rather than collapse when the unit of measurement itself becomes less reliable? Before we go further, it's important to clarify what this discussion is not about. It is not about stockpiling supplies, retreating from society, or betting on chaos. Those responses come from anxiety, not intelligence. Nor is it about chasing speculative assets fueled purely by fear and momentum. Instead, this is a discussion about ownership, specifically ownership of productive value. Across decades of economic upheaval, one principle has remained remarkably consistent: assets that generate real output tend to endure. Assets that rely solely on promises, fixed payments, or faith in paper alone tend to struggle when conditions change. The goal is not to escape the economic system, but to align yourself with its most durable components, to shift your mindset from that of a passive holder of currency to that of an owner of value. With that perspective, I want to outline what I believe are the most rational forms of protection against long-term currency weakness. These are not short-term tactics or dramatic hedges. They are long-standing principles grounded in productivity, adaptability, and human necessity. The first, and arguably most important of these assets, is often overlooked when uncertainty rises: ownership in exceptional businesses. In the next section, we'll explore why becoming an owner of productive enterprises is not only a hedge against inflation, but one of the most logical responses to monetary uncertainty ever devised. When economic uncertainty increases, many people instinctively look for exits. They hold more cash, retreat into fixed income promises, or search for something they believe exists outside the system altogether. In my experience, that instinct often does more harm than good. The most resilient response to long-term currency weakness is not withdrawal, it is ownership. Specifically, ownership of high-quality, productive businesses with durable competitive advantages. These enterprises do not merely survive economic shifts, they adjust to them. They raise prices, replace assets at higher values, and continue serving essential needs regardless of what happens to the purchasing power of money. To understand why, We need to clarify what truly makes a business exceptional. The answer is not short-term growth, excitement, or popularity. The defining feature is what investors often call an economic moat, a structural advantage that protects profitability over long periods of time. Think of a business as a valuable property. Without barriers, competitors can easily enter, eroding margins and stability. A moat prevents that. It creates staying power. These moats come in several forms. Some companies build such powerful trust with customers that price becomes secondary. Others operate under regulatory frameworks that limit competition, such as utilities or essential service providers. Some benefit from scale or network effects, where the service becomes more valuable as more people use it. Others achieve cost structures so efficient that competitors cannot realistically match them. What matters is the type of moat, but its durability. Now consider why these businesses offer protection when a currency weakens. A common misunderstanding is that stocks are simply pieces of paper whose value rises and falls with market sentiment. In reality, a share represents ownership in an operating enterprise. That enterprise owns assets, employs people, delivers products, and generates cash flow. If the value of the currency declines, the prices of goods and services rise in nominal terms. Businesses that sell essential or widely demanded products can adjust accordingly. Revenues increase in the same weakened currency, while the real productive capacity of the business remains intact. Think of it this way. If you owned a small but efficient manufacturing plant and the currency lost half its purchasing power, you would not sell your products for the same nominal price. You would raise prices to reflect the new reality. The plant, the equipment, and the know-how would all still exist, and in fact, their replacement costs would likely be higher. The same principle applies to large, well-run companies. Their factories, brands, logistics systems, patents, and customer relationships are real assets. As money loses value, those assets are repriced upward. Ownership adapts. Fixed claims do not. This is the crucial distinction. Cash and long-term fixed payments lock you into a future repayment that may be worth significantly less in real terms. Ownership in productive businesses gives you a claim on whatever value those businesses produce in the future, regardless of the currency used to measure it. Importantly, this is not about guessing which company will outperform next quarter or next year. It is about owning enterprises that can remain relevant for decades. Businesses tied to basic human behavior, consumption, communication, transportation, energy, and payments do not disappear because currencies fluctuate. For most individuals, attempting to select individual businesses is neither practical nor necessary. A simple, low-cost way to own a broad collection of these enterprises is through diversified equity funds that represent the most resilient segments of the economy. When you own such a fund, you are not betting on short-term market movements. You are owning slices of hundreds of productive companies simultaneously. In a true currency decline, it is not the productive assets that fail, it is the measuring stick. When money weakens, real businesses reprice. Ownership survives. This principle forms the foundation of every rational long-term strategy. And it leads naturally to the next category of protection. Assets that are not just productive, but physically rooted in the real world itself. Beyond ownership in exceptional businesses, there exists another category of protection that has endured across civilizations, currencies, and political systems. These are assets whose value is not derived from contracts, promises, or financial engineering, but from their dirt. ECT, connection to physical reality and human necessity.er. At the core of this category is productive land. Not all land qualifies. Speculation on undeveloped plots or purely cosmetic real estate offers little protection in times of monetary stress. The land that matters is land that produces, farmland that grows food, timberland that supplies raw materials, and real estate tied to essential economic activity. Human beings may adapt their technology, their lifestyles, and even their social structures, but they do not outgrow the need to eat, build, and consume energy. This simple biological fact is what gives productive land its enduring value. When currencies weaken, prices of necessities tend to rise first. Agricultural commodities, lumber, and basic materials do not wait for financial systems to stabilize. They respond immediately to changes in purchasing power. As those prices rise, the land that produces them becomes more valuable, not symbolically, but functionally. A field that can produce crops year after year is not dependent on confidence in a financial institution. Its output is tangible. Its value comes from biology, climate, soil, and management. No central authority can create more fertile land with a keystroke. This is why productive land has quietly preserved wealth for centuries. It does not rely on speculation or sentiment. It produces value continuously, regardless of what happens to the unit used to price that value. Closely related to this idea is ownership in critical infrastructure. These are the systems that allow modern economies to function at all: transportation networks, energy distribution, communication systems, and logistics corridors. While they may not attract attention, they are indispensable. Infrastructure operates much like a toll system embedded within the economy. Goods cannot move without transportation. Energy cannot be delivered without networks. Data cannot flow without physical systems supporting it. Every transaction, whether digital or physical, relies on these foundations. What makes infrastructure particularly resilient is the sheer difficulty of replication. Building a nationwide rail network, an energy grid, or a pipeline system requires enormous capital, regulatory approval, land access, and time. These barriers create natural monopolies or limited competition environments. When inflation rises or currency weakens, the replacement cost of infrastructure increases dramatically. Steel, labor, fuel, and materials become more expensive. Existing systems already built and operating become more valuable simply because recreating them would be prohibitively costly. In many cases, the revenue models of infrastructure assets adjust alongside inflation. Transportation fees, energy rates, and service charges tend to rise with the broader price level. The asset does not shrink as currency loses value, it adapts. Another often overlooked form of protection lies in geographic diversification. When all assets, income, and savings are tied to a single currency, risk becomes concentrated. This is not a political statement, it is a mathematical one. Owning productive assets across multiple regions and currencies spreads exposure. Businesses operating in different economic systems generate income in different units of value. When one currency weakens, others may strengthen or remain stable, providing balance. This approach is not about speculation on foreign exchange movements. It is about diversification of productive ownership. A business earning revenue in euros, yen, or other stable currencies provides an additional layer of resilience when measured against a declining dollar. Perhaps the most underappreciated asset of all, however, requires no brokerage account, no land deed, and no capital investment. It is your own ability to produce value.br. Skills, knowledge, judgment, and experience are inherently resistant to inflation. A person who can solve problems, provide essential services, or create needed solutions remains valuable regardless of monetary conditions. Currency may change, but competence does not disappear. In times of instability, practical expertise becomes more valuable, not less. The capacity to adapt, learn, and deliver real outcomes is the most portable form of wealth there is. These forms of ownership, productive land, critical infrastructure, diversified assets, and personal capability, share a single characteristic. They are tied to reality, not abstraction. They create, move, or sustain value in ways that cannot be diluted by printing more currency. That principle, above all else, is what endures. After decades of observing markets, economies, and human behavior, I have come to recognize a single principle that unites all truly enduring forms of wealth: ownership of productive value, not passive hope. Whether it is a business, land, infrastructure, foreign revenue streams, or your own skills, the underlying theme is the same. Invest in what creates tangible benefit for society and for yourself. Many people approach money as a series of numbers on a screen or pieces of paper that must be protected. They chase fleeting trends, hop between speculative assets, or cling to cash because it feels safe. The flaw in this approach is simple. Cash does not produce. A stock certificate does not feed anyone. A bond does not build anything. Over time, these passive holdings can erode as inflation or currency shifts eat away their real value. In contrast, productive assets generate outcomes. They make goods, provide services, or deliver value that people will always need. Their worth is not tied to sentiment, it is tied to reality. That is why they are resilient in the face of currency fluctuations or economic turmoil. Even more, the most important asset you possess cannot be bought: your own ability to contribute. Skills, knowledge, judgment, and problem-solving capability are inherently inflation-resistant. A doctor can heal patients. An engineer can design critical infrastructure. A farmer can grow food. A skilled professional can create essential products or services. These capabilities retain value regardless of the currency in which payment is made. In fact, during times of uncertainty, practical competence often becomes even more valuable. Investing in yourself is therefore the foundation of all other investments. Education, experience, and mastery of a trade are permanent forms of wealth. They compound over time, and they are portable. They travel with you wherever you go, immune to the whims of monetary policy or financial markets. The unifying principle across all these forms of wealth is the mindset of ownership, not speculation. Speculation hopes for someone else to pay more in the future. Ownership ensures you control something that produces real value here and now. It shifts the focus from worrying about the dollar's short-term movements to benefiting from human activity that continues regardless of monetary fluctuations. This philosophy does not promise safety in every short-term market swing. You will face volatility, corrections, and unexpected events. But those who maintain a disciplined focus on productive ownership will find themselves better protected against both inflation and economic uncertainty. The strategy is not about avoiding risk. It is about aligning with reality in a way that ensures long-term resilience. Above all, this approach builds confidence rather than fear. By investing in what produces, whether it is businesses, land, infrastructure, foreign earnings, or your own skills, you anchor your wealth to fundamentals. You do not rely on luck, speculation, or hope that currency will remain stable. Instead, your assets adapt to the world as it exists, and they will continue to create value regardless of the economic climate. So, the lesson is simple: embrace ownership. Focus on assets that generate productivity. Protect your personal ability to contribute. Let rationality, not panic, guide your decisions. By doing so, you are not only safeguarding wealth, you are participating in the ongoing creation of value, which is ultimately what all money, all investment, and all security depend upon. In the end, the key to preserving and growing wealth is not fear or fleeing the system. It is active engagement with the productive forces around you. Seek opportunities that provide tangible, durable value. Commit to lifelong learning and skill development. Own what matters. Invest in what produces. And remember, the most important asset you will ever have is yourself.